Welcome to The Explainer. Today, we are uncovering the hidden, almost invisible forces moving the gold market, and we're doing it by looking strictly at real, unvarnished data. Now, if you've been following the markets recently, you know gold is an absolutely massive topic right now. But what you read in the screaming headlines and what's actually happening behind the scenes, well, they're often two entirely different things. We're going to look closely at hard market data from April and May of 2026 to see exactly what the biggest players in the world are really doing with their money. And this brings us to a very serious question that every investor needs to be asking right now. Are you walking right into a gold trap? You see, when everyone seems to be making heavily bullish bets on an asset, it usually means the market is getting dangerously crowded. And when a market gets packed with everyday investors just hoping for a breakout, institutional players are absolutely notorious for setting traps. You might think you're catching a massive upward trend, but the data suggests you might be playing right into the hands of the financial heavyweights. Okay, let's dive into this. To figure out if it's really a trap, we have to rely on our ultimate forensic tool, the COT report. That stands for the Commitments of Traders Report, and it's published weekly by the U.S. Commodity Futures Trading Commission. I want you to think of this report as a financial truth serum. It doesn't care about opinions, it doesn't care about news articles, and it definitely doesn't care about hype. It strictly categorizes and tracks the actual open futures contracts on the COMEX. It lets us see with total clarity exactly where the smart money is heavily betting and, unfortunately, where the dumb money might be getting completely stuck.
All right, moving into Section 1, the giant concrete wall. Let's take a look at the first major suspect keeping a lid on this market.
To understand the current market ceiling, we have to talk about the big banks. Now, in the COT data, they're officially known as swap dealers. Let's look at exactly what they're up to. Here is the raw, undeniable data. The big banks are currently sitting on a net short position of minus 179,823 contracts. What does that mean in plain English? Well, a short position means they are betting on the price to go down, or they're actively resisting a price increase. At this unbelievable scale, it means these banks have mathematically promised to sell almost 17.9 million ounces of gold at future prices. Historically, anytime the bank net shorts exceed 150,000 contracts, the market is dangerously overbought. So at nearly 180,000, they are literally the single largest force actively keeping gold prices from rising. And this brilliantly illustrates exactly what that massive short position feels like in the real market. Imagine a giant, immovable concrete wall built right at the $2,500 per ounce mark. The banks built that wall. They have unimaginably deep pockets and immense market influence. Every single time the price of gold tries to rally and break higher, the banks just step in and sell more contracts. They essentially absorb all that enthusiastic buying energy and push the price right back down. They're just sitting there totally comfortable, waiting for the buyers to completely run out of steam.
Which leads us perfectly into Section 2, trapped by weak hands.
So, if the banks are the immovable object, who exactly is the unstoppable force trying to smash through that wall? Let's pivot and look at the opposing forces in this market, the hedge funds and the retail traders. In the COT report, hedge funds are categorized as managed money, and right now they are holding a massive 94,254 net long contracts. They're heavily betting that gold is going to surge. In fact, their short position is absolutely tiny by comparison. But the problem here? Nearly 100% of these trend-following hedge funds are crowded onto the exact same side of the boat. It makes the market incredibly top-heavy. It literally only takes one small wave, say a minor price drop of $50, to cause these funds to totally panic, tip the boat over, and kick off a cascading sell-off.
You can actually see this nervous instability in the timeline of the data. Look at this 3-week progression. On April 21st, they held roughly 93,000 longs. A week later, on April 28th, the market shook just a little bit, and what did they do? They started selling, dropping down to 89,752. But then, by May 5th, FOMO kicked in, they completely changed their minds and bought right back in, pushing the longs up to over 94,000. Listen, this is not the behavior of confident long-term investors. This is nervous, unstable, purely reactionary trading. They are incredibly quick to jump ship, which makes them exactly what we call weak hands. Now add this number to the mix, positive 35,632. This represents the non-reportables category, which is essentially just everyday retail traders. They are heavily betting on gold to go up as well. Why is this so important to watch? Because historically, in financial markets, retail traders are absolutely famous for buying right at the absolute top. They see the flashy headlines, they feel the FOMO, and they buy in. Professional traders actually use this exact number as a signal. When retail net longs pass 35,000, the pros know it is time to sell, because retail will always be the first to panic sell at a massive loss when the price finally drops.
And that brings us to Section 3, the zero-sum game.
Okay, so we've got banks heavily shorting and hedge funds and retail heavily buying. To figure out who's really pulling the strings in this mystery, we need to understand a fundamental mathematical law of futures markets. It's called the zero-sum game. Unlike the stock market, where a company can just create new value and everyone's shares go up together, the futures market is completely different. It is a mathematical certainty that for every single winning position, there must be an exact corresponding losing position. For every buyer of a contract, there simply must be a seller. So if we want to prove who is dictating the terms in the gold market, we just have to look at the total balance of buyers and sellers across the board.
Now, what's really interesting about this breakdown is the perfect mathematical balance it reveals. On the top half, you have your buyers, hedge funds, pension funds, and retail traders. Add them all up, and they're holding roughly 198,935 long contracts. On the bottom half, you have your sellers, the gold producers, the miners, and the banks. Add them up, and they are exactly minus 198,935 contracts. The math balances perfectly to zero. But here is the massive takeaway you need to catch. The big banks alone are absorbing almost the entirety of the buying frenzy from retail and hedge funds. The institutions are comfortably and quietly taking the exact opposite side of this crowded trade.
So what do we do about it? Let's get into Section 4, the mathematical buy trigger.
We've outlined the problem, right? A super crowded market facing a giant concrete wall. But let's shift to the solution. When is the actual right time to get in? Well, the data gives us a precise mathematical target to watch for. We don't have to guess when the trap is cleared. We literally just have to read the numbers. Right now, the current setup shows managed money, those hedge funds, sitting at over 94,000 long contracts. But the mathematical trigger to safely buy gold requires that number to drop down to around 70,000. That means we are still over 24,000 contracts too high. Those weak hands we talked about earlier, they are still entirely in the market. Before it's safe to establish a new bullish position, we need a price drop significant enough to flush out those 24,000 nervous contracts. Only then will the market have the structural stability to actually move higher.
So the crucial point is how you actually apply this to your own personal strategy. Based strictly on this data, here are the action steps. If you already own gold, hold it, but absolutely do not add to your position right now. If you don't own gold, just wait. Do not chase this price higher. What you need to do is watch the weekly COT release every single Tuesday. Look for the hedge fund longs dropping down to that 70,000 mark. That is your clear signal the flush is complete. And watch for the bank shorts dropping below 150,000. That's your signal the concrete wall is finally coming down.
Ultimately, it all comes down to market psychology versus cold, hard math. The headlines are going to try to induce FOMO. The crowd will try to convince you that somehow this time is different. But the data shows us exactly where the trap is set. So I leave you with this to ponder until the next report drops. Will you let the fear of missing out trap you right alongside the retail crowd? Or will you exercise patience and wait for the mathematical trigger to clear your path?